Chapter 5: The Pain of Losing. Unless you can take the pain, you will never be able to participate in the gain. The new investor does not realize that stocks are, with or without reason, supposed to fall after he buys and rise after he sells. The heartburn of falling prices to an individual investor after he has bought a stock and of rising prices after he has sold one is much more than what he would be once he assumed maturity and seriousness. With time and experience, an investor manages to change the focus from short term stock price movement to the company fundamentals. A change in stance which is gradual and comes with success. However, the momentary pain of losing paper capital puts most investors away from stocks as people prefer a lower consistent gain to a lumpy higher return. As the pain of losing is always more than the joy of winning, a person on a losing streak is more likely to focus on falling prices than if he were on a winning path, not realizing that if an investor fears the bear, he would never be able to ride the bull, equating temporary price drops as loss of tangible goods. Stocks do not go up in straight line, and the ones that do comes down equally fast. The emotion of seeing wealth erode for no reason is a painful stress for all the new investors and most of the old ones. To an investor who takes local transport from work in order to save money for investing, a 20% fall in price on a 5 lakh portfolio becomes a difficult proposition to handle. When I had a small portfolio, such price drops created a feeling of having been pickpocketed, as it took time to understand that such drawdowns were perfectly normal to the life of an investor. The new investor might not be able to take such losses very kindly, as each percentage fall in the portfolio value is generally equated with the loss of a tangible asset. For example, if the portfolio falls by 50,000, the investor will engage in self torture for a flat screen television that he did not buy just to initiate his investment process. The imaginary discomfort from not buying things of comfort, even though they were depreciating asset, will increase for every subsequent fall, not realizing that a fall in stock price can be arrested and reversed while there are no such options available from depreciating asset. A stock that falls to rupees 20 from 30 can always go back to 30 and beyond, but a car that cost 5.5 lakh encounters a permanent irreparable 20% loss the moment it rolls out of the showroom. A investor who thinks that he should have bought the stock when it went to rupees 20 and not when it was at 30 will soon understand that tops and bottoms are caught only by fools and liars. The process of seeing a stock go down is very much a part of an investor's life. It is like falling down for a child while he is learning to walk or being unable to float the first time a person is pushed into the swimming pool. Investing is about making less and relating more. Rather, investing is about making less and retaining more rather than making more and retaining less. Sometimes the pain of losing is real and originates from a bad investment decision where the only recourse would be to book the losses and run. Here, an investor should remain focused on doing what is right rather than worry about taking losses. Many investors approach this situation with a view to cashing out when they can recover their cost price. The reality, though, is that the market does not care about whether an investor gets his original capital back or not. All that it knows is to price the stock on the basis of the available information as disseminated by the collective opinion of the participants. The pain of losing is always greater than the joy of winning. All losses appears permanent till the time they actually reverse the trend, because whether the losses are temporary and reversible or permanent and irreversible can be answered only in hindsight. No matter how much an investor is told about not panicking, he would start panicking from the moment the stock goes below his purchase price. On the other hand, if the stock moves up, the investor experiences imaginary pain of losing the profits. Profits to an initial investor do not come with easy recurrence. So, whenever he finds any of his stock in profits, he starts thinking of the loss in this notional profit that he would have to bear if the stock were to go down. The fear of losing profits or making losses creates a negative mindset which compels an investor to think of the consequences rather than the processes, and encourages him to focus solely on the price and decide his wins and losses on the basis of daily market movements. One way of getting around the pain of seeing the stock fall is to buy more of it, but as most investors are already invested to their initial allocation, the scope of increasing exposure is limited nearer to the lows, as lower prices also brings down the self belief and conviction levels of the amateur investor. It is generally a bad decision to average a losing trade, though this advice is more for traders, but putting good money after bad is another feature of an amateur investor. An amateur investor's pain is also a relative feature. It is easier to bear the pain collectively when all his friends and relatives are losing money than it is when he is left alone on the loser's side. There is a strange sense of comfort in seeing everyone else lose money, more so on the same stock or the sector. This works something like the lesser discomfort of falling when the whole class does poorly in a high school mathematics exam than it is when the student fails alone. The pain is also relative. An investor who moves from a portfolio value of 1 crore to 1.5 crore might be overjoyed in celebration, but a few years later the same investor might suffer much more pain when he moves down from a portfolio value of 4.7 crore to 4.2 crore. The pain of losing is based on the immediate past set of events. Extending the argument, an investor who is pained to see a stock move down from 450 to 300 feels settled when the stock stops falling and holds itself at 300 because he gets used to new prices on the screen. This sorrow turns into indifference and will again change to joy even if this stock were now to move up 375, which is much less than the price from where it initially started to fall from. Buying with blood on the street. The common glitch in the market is about buying with blood on the street. But no one suggests as to what an investor should do if it's his own blood on the street. The original statement was supposed to mean that an investor should be buying when prices are plummeting because everyone else is selling, but a normal investor in such a situation is already under tremendous pressure as he struggles to manage his original conviction and fights a mental battle on whether to retain or let go of his portfolio. He is short on cash and overloaded with fear, and asking him to buy under such circumstances is bizarre. If he were truly convinced in a stock, he would have already bought it. If not, he will just wait and maybe regret his miss after the stock moves up again. The advice of buying when there is blood on the street is subjective and vague. No one can quantify how much blood is enough for an investor to call his broker up. For an investor, the first 8% fall can be called blood on the street. But what if the market falls by another 18% from there? Generally, the first drop of blood is followed by many more, and hence, trying to buy at the first sell off could be an aggressive movement into a losing trade. A better option to exercise in such case is to let the blood dry and then seek to buy again. Many times a deep market cut does not encounter immediate revival but follows a sideways pattern for several days and maybe weeks before moving up again. It is only in certain random cases that a deep cut is followed by a sharp pullback, but irrespective of that, an investor should be focused on buying when he sees value and not just because a stock has come down from a higher price. Generally, in a market decline, the stock that fall are not the ones that an investor would like to buy, and the one that he wants to buy are not the ones that fall, making the theory of buying with blood on the street a little more confusing to understand and difficult to execute that than that what it actually is. If the bull market has ended, then an investor should not be buying the bleeding bull market stock at all, but look at other options as the leading bull market sector faces maximum damage once the party gets over. Conversely, stock that show strength in a bear market do so because their inherent fundamentals are strong, and when the next up move happens, such stocks are most likely to make the big move forward. It's not just pain of losing that eats up an investor's mind. An average investor also keeps worrying about the pleasure of not winning from a stock that has not moved from the time he has bought it. But if the story is robust and well conceived, the gain will be well worth the wait. Sometimes the act of waiting endlessly, even in a promising idea, isn't such a good strategy as it is thought out to be. One can wait for prices to go up even as earnings are rising, but waiting for the company to deliver better earnings is an option that an investor should ignore. Though stocks are supposed to be valued on promise, markets pay on performance. It is much better to buy a stock after it has started to show improved earnings than on its anticipation of doing that. Wealth creation needs patience. It's easy to sit with a stock delivering earnings growth than to stick with an investment whose earnings are going nowhere. While investors should focus on the long term, sometimes holding a stock which shows no price action under the veil of long term investing isn't the best option for an investor unless the company has been reporting improving fundamentals. A point to consider is Nestle, whose stock went nowhere from 1999 to 2005 before rising 10 times in the next 8 years, and Asian Paint, which is up more than 2000 times over the last 29 years and was up just 3 times for the period 1992 to 2002. Both these companies were doing well despite the stagnating stock prices, and hence their investors were in the long term adequately rewarded for the waiting period. Borrowed conviction is dangerous. An investor who buys stocks on self research is better equipped to handle the downward movement in stock prices than the one who buys stocks on borrowed conviction. While stealing ideas is easy, borrowing conviction isn't, and the work only as long as the trade moves in favorable direction. An investor who buys stocks on borrowed conviction is more vulnerable to be making a wrong decision by either selling out too early or by holding it too late. In investing, return create conviction and conviction generates returns. Something like the chicken and the egg syndrome. But most investors start from the return side because it's easier that way. Making income is different from creating wealth. The former has to be done repeatedly, while for the latter, once is enough.